first speaker in the private market session, Jeff Marshall from CI GAM in Toronto. Jeff manages the fixed income platform at CI alongside his responsibilities for leading their private markets business. He studied political science and is a CFA. Jeff's role today is to give us a sense of how to tackle the beast that is private markets and to introduce a couple of video perspectives from some of the managers he uses in their multi-strat universe. So bear with us when you see some footage. It's just an insight into a couple of those partners. Spoiler alert, private markets do make your overall portfolio stronger. But no, you can't have daily liquidity. So we're not going to talk about liquidity or product structure or anything like that. We're just going to talk about whether or not there's something in this private markets machine that we need to look at and how all of us can possibly do our day job and then go and look at the 30,000 funds out there that all offer you something different apparently in private markets. This is a difficult market to consume, so we're here to help you and help ourselves try and figure out whether we want to prioritise more time in this area. When it comes to private markets, it's almost the exact opposite of how we put together our listed markets exposure with a core, right? A core and then some tilting around the edges from valuation or defensiveness perspective. In private markets, most of us have put a couple of PE funds to work or a couple of private credit funds to work. There is no core. So the premise today for Jeff to present is to talk about that SAA aspect and to see whether or not we need to think about things differently, flip it on its head and think about core first, satellite second, just like we do with our listed exposures. CI GAM started working hand in hand with what is now the world's largest independent ultra high net worth wealth business in the world to build this core portfolio platform. So that's this room putting $250 billion to work, which is probably about right if you look around the room, pulling your assets and getting 30 analysts to spend all their time trying to figure out what to do with these 30,000 funds available to them and coming up with the best 15 to 20 ideas. A portfolio built by advisors for advisors. So, not coincidentally, we're delighted to announce we'll be bringing this portfolio to the Australian market at the end of this year, and we look forward to talking to you more about that. I wanted to use the words activate your core, but the team said I wasn't allowed to say that, so I won't mention it. Ladies and gentlemen, Jeff Marshall.
Thank you very much, Ben. Thank you for the Pet Shop Boys walk-on music. Thought it might be helpful to energize the room post-afternoon tea. And to echo Ben's comments, thank you very much for sticking with us over the course of this afternoon. I'm going to talk about what we think is the better mousetrap to access the private markets, especially that core part of what should accompany or what should make up your client portfolios. It requires solving for selection, access, and pricing. I'm really going to talk about three things, which you can boil down to the why, the how, the what, and the when. The why is why do private markets work for your clients' portfolios? And as a Canadian, I've got to introduce a hockey analogy. It goes to a quote from, actually not the one on the screen, but it goes to a quote from the father of Wayne Gretzky, which is skate to where the puck is going. As in don't skate where the puck is, that's obvious, skate to where the puck is going. The second point, the how and the what, is private markets are difficult. So how do you get to a strategic asset allocation and what strategy diversification, manager diversification, and vintage diversification is required to do that properly. And the when is, markets are evolving. What kind of tactical tilts can you introduce into your portfolio to take advantage of that? So on the topic of the why do this, on skating to where the puck is going, fundamentally what we're trying to do is take advantage of the illiquidity premium in the private markets, whether that's 2 to 5% over the public markets. And we also know these are assets that have fundamentally less volatility than the public markets. And so you introduce some lack of correlation and some overall portfolio efficiency. So as we think about the public markets, in terms of the public markets being challenged, they're shrinking, both on the equity and the debt side. Correlations both inter and intra asset class are rising. We also have a lack of breadth, lack of leadership. Think about the Mag 7. And more companies are staying private longer. So you've got a challenge in your public market portfolios. Sophisticated pension plans, sovereign wealth funds are solving for this, and you'll see they've got 30 to 50% of their portfolio allocations to private markets. Because what they're trying to do is, yes, solve for higher returns, solve for vol dampening, find weaker correlations, and drive better competition, drive better client outcomes. So how do you intelligently incorporate private market assets into your otherwise public market portfolio? So our approach was to try and optimize the portfolio for returns, for volatility, and for liquidity, looking at correlations between the asset classes, correlations between managers, deployment of capital into the market, distributions of capital back to clients, correlations with the public markets. And what we found was a portfolio, a strategic asset allocation, to Ben's point, that mimicked what the large pension plans were doing. So across private equity, private credit, infrastructure, venture capital, real estate, on a multi-asset, multi-manager, multi-vintage basis, and also on a multi-structure basis, where some evergreen funds provide us liquidity alongside the closed-end funds that we would otherwise own. And essentially at the heart of what we're suggesting is the right strategic asset allocation can turn your client's 60-40 or 50-30-20 portfolios into something that's more efficient. And this is essentially what I've tried to show on the graph, is we introduced a 10% model weight of a private markets growth portfolio into a 60-40 portfolio, into a 50-30-20 portfolio, and essentially we're able to move up and to the left, right? You think about the efficient frontier, up, higher returns, to the left, lower volatility. So the how and the what, it requires the building of diversified portfolios, and your counterpart might be, I don't want a diversified portfolio. But then you have that challenge of that target approach where you have a fee issue. You need scale really to get a break on fees. You have minimums to access certain vehicles. You have an access issue. You've got to even get into the best-in-class managers. It's difficult to do tactical tilts. And at the heart of what we're doing in the private markets, manager selection is incredibly difficult. So the issue with manager selection is one of path dependency. As you think about your portfolios, is your private market exposure built from a really top-down search in terms of I wanted private equity, so I did a dedicated, diligent search on who was the best private equity manager? Or was it really the first private equity manager that made a compelling pitch, or is it a golf buddy? I think path dependency creeps into our portfolios, public and private, on all sides. Once we came up with a strategic asset allocation, we ran a disciplined process on finding the right risks, finding the right managers. And it's a quantitative process. It's a qualitative process, background checks, manager interviews, references, working from a Mercer database, and narrowing that funder down from 30,000 funds down to a more manageable list of 10 to 15 that's going to populate the funds. And we can do that. And we can do that because we've got a very, very dedicated team across our Canadian and US businesses. So what I tried to capture on the chart is just the importance of manager selection. Manager selection in the public markets, consequential. You can always fire the manager. But the difference between first and third quartile might be 50 to 100 basis points, 200 basis points. In the private markets, much more difficult to exit an investment. And the difference between first quartile and third quartile is 500 basis points, 1,000 basis points. Very significant. So dispersion in the private markets, much greater. The persistence of outperformance, much stronger. Manager selection is incredibly important. On the when, like when to engage with the private markets, I'd say we know the public markets are challenged. We've got valuations in the private markets that are 2.5 turns cheaper, and that's just private equity to the Russell 3000. So that mitigates the impact of the Mag 7. We've got stronger earnings growth. We also know the private markets are growing and innovating. So I think about the growth of secondaries, of continuation vehicles in PE. I think about the phenomenal growth in private credit, how private credit is disintermediating banks. And banks are very willingly letting that happen. I could talk about that for 20 or 30 minutes. But my point is, navigation is required when you think about getting involved in private markets. We know that private markets are going to lag public market performance. As I think about how I want to tilt a portfolio, or what the recommendations I want to make to you, generally my experience is that advisors that are already involved in private markets have started with real estate. And so they're generally starting from an overweight position. I think valuations are fine. They've reset materially since 2022. Private credit, too, I spoke about that. Tremendous amount of growth, and I think that's supposed to make you a little bit cautious. In some ways, the underwriting of risk in private credit is the easy part. The origination, do you have an origination advantage? Can you actually put to work the money that you've raised? I think that's going to be an incredible challenge over the next 10 years. So my words of wisdom there would be careful who you partner with in the private credit space. What gets me most excited is actually the private equity space, where we have this lack of exits, this lack of monetizations, lack of distributions back to limited partners, compounding a lack of ability of fundraising by some firms. Mark Rowan at Apollo made the point last week at a financial services conference in New York that many private equity firms have raised their last fund. They just don't know it. Makes me think, if private equity is having trouble selling, and I'm starting from the ground floor, I want to be putting capital to work in that environment. What I wanted to leave you with in terms of timing and participation in the private markets, you think about the chart that I've put in front of you, and that's private equity's performance relative to the S&P 500 on a 3-year basis. I think we're starting from the right-hand side of this chart. Very significant S&P 500 performance. PE still outperforms, but as S&P performance weakens, and I think that momentum probably has to come out of that trade at some point, the outperformance of private equity strengthens as S&P returns weaken, and I think that's the environment that we're headed into. So I think the onus is on you as you think about educating yourselves on private markets. I think now's a very, very good time. So my closing remarks, I want to encourage you to think about how to work private markets into your clients' portfolios, trying to get those better client outcomes up and to the left. It requires the right vehicle, a strategic asset allocation. It requires the right process and discipline on manager selection. In terms of evolution equaling opportunity, to Ben's point, I encourage you to really apply the same discipline that you apply to your public market portfolios in terms of core and explore to the private markets. Take that path dependency element out of your process. So, Ben, I understand we've got some videos. I'll turn it over to you. Thank you for spending the afternoon with us, and I'll be around later for cocktails.
Thank you, Jeff.